And a $2.6 million, we raised it in 48 hours. It was an easy raise for us because the deal was phenomenal.
Wait, you said you raised it in 48 hours?
Yeah, in 48 hours. Yeah.
Hello, and welcome back to the Very Real Estate Effect podcast, a show dedicated to real estate investing in North America. And today, it's a pleasure and an honor to have a guest from sunny Florida. Hi, Gino. How are you?
Excellent. Doing great, brother. How you doing?
Super good. So just before we started, I was complaining like, oh, it's hot here. And then I look at Gino and I'm like, yeah, okay. It must be even hotter in Florida. So I'll take that back. So Gino Barbaro, you scaled your portfolio super quickly. You're based in northern Florida. And, as I always start, how in the world did you get started in real estate investing?
Well, I had what I like to call my journey was life before Jake, which is my business partner, and life after Jake. Before Jake, a lot of mistakes, a lot of mishaps. Wasn't even focused fully on multifamily. And when I met Jake, fortunately, back in 2009, we're affectionately called the pizza guy. I had a restaurant and he's the drug rep. He was working for Glaxo in the pharmaceutical industry. He was coming into my restaurant to take out food orders to go to doctors' offices to sell pharmaceuticals. And we both looked at each other and we both said, we want a little bit more out of life than just having a small business and being a W-2. So we got together and he moved down to Knoxville, Tennessee back in 2011. And we started looking at deals. And in 2013, we purchased our very first 25-unit property. And since then, we're talking a little over 10 years later, we've been able to purchase over 2,200 units. We've exited 600. And I think, Axel, it comes down to the framework. It comes down to my experience of making a ton of mistakes, of doing what didn't work, and then creating that framework, the buy right, the manage right, and the finance right, and really sticking to it. And it sounds like a lot. And I know it really is. 1,600 units is a lot. But if you drill it down and you really rip it down into 10, 11, 12 years, if you're doing 100 units a year, before you know it, you're at 1,000 units. So we always overestimate what we can do in 1 year, but we truly underestimate what we can do in 3, 5, 7, even 10 years.
Absolutely. No, and you're absolutely right. And when it comes to scaling, you said it perfectly. Like if you try to stick to, let's say 80 or 100 units a year, after a couple of years, like it adds up quickly.
It does.
So let's start with your first deal. You said it was a 25 unit. How'd you find it? How'd you fund it? And how did that all work?
It's actually interesting. I always like to equate our first 3 or 4 years into the business as if someone's going to college. We met and we started doing deals in 2009, but we started actually looking in 2011. So from 2011 to 2013, those 18 months, we had goose eggs. We got kicked out of brokers' offices. We didn't have credibility. Nobody wanted to do business down in Tennessee with 2 Italians. Y'all ain't doing business down here. That was the reality. I'm not even making it up. We heard that so many times. But finally, in February of 2013, we found the broker, Ricky G, and the deal was online. It was on LoopNet. Back then, there were deals on LoopNet. And guess what? There are deals on LoopNet today as we speak. But that's how we found our very first deal after 18 months. So you go from 0 to 18 months. It feels as if I'm a sophomore in college.
Yeah.
And, at 25 units, it was a $600,000 deal. We actually got seller financing as part of the down payment. So 10% was a seller carryback. 10% Jake, my brother, and myself had to put down as a down payment. It was $83,000 as a down payment. And the other 80% was funded by the bank. But the interesting thing was, wow, you got your first deal, took 18 months. 3 months after that, good old Ricky G, the broker, sends us a second deal, which is a 36 unit. And it's like, okay, how do you start scaling? Well, one of the components to scaling is you need somebody with a strong balance sheet. Jake didn't have a strong balance sheet. He's hitting up his grandma for money. I didn't have a strong balance sheet, but we found my partner, Mike, through the restaurant. He used to come in the restaurant, take out catering orders, and he was able to utilize his balance sheet for us to be able to start qualifying on these loans. So from there is a second deal. The third deal is 6 months after that. So you're talking like within 2 years, we're at 200 units. And then within 4 years, we're at around 600 units. So you can see it takes a while to get going, like everything else in life. But once you get some momentum and you get some credibility, and you get people believing in you and you start understanding the process, things do get to start moving a little bit quicker.
Mhm. And so all those assets, are they in Florida or in Tennessee?
No, the vast majority of them are all in Knoxville. Axel,
Oh,
I was living in New York at the time. Jake moved
okay.
to Knoxville. And I decided in 2017, let me move to Florida. I want to start building the property management company and buying assets in Jacksonville. That's where I wanted to start buying. But when I got down here, you probably experienced this in Quebec too. Everyone in Jacksonville, back in 2017, they're telling me, oh, the deals are too expensive down here. These cap rates are crazy. You'd be nuts to buy. So what did I do? I listened to the locals when I should have
Mhm.
just listened to myself and said, these deals are great. They were like 80,000 a unit, 90,000 a unit. Now they're 150, 160, 170 a door. If you're lucky, you can find them. So I said, you know what? I'm going to pause it. I'm going to start Jake and Gino, the education company, and we're going to continue to scale in our market of Knoxville, Tennessee.
Mhm. Okay. So then you went from there, and you said you had that third partner that came in who was the money side, and he was
Hmm.
financeable. At
Yes.
what point did you start to bring in some other partners and investors and so on? Because at some point you kind of tap
Yes.
out your grandma, your mother, your sister. Like at some point you got to bring in some other capital. No offense.
No, I mean, none taken. And it's interesting. By that time, on our third deal, we asked Mike to lend us $500,000 for our third deal. It was a $4 million deal. He lent the entity $500,000. He diluted himself in effect because he
Mhm.
saw the opportunity. So when we refinanced that third deal, we paid him off first. But great question. On our fifth deal, to me was I guess the deal of the century for myself. It was a 236 unit deal.
Yeah.
And it was an $11 million deal. It was fully seller financed, 80% by the bank, 20% by the seller. So we didn't
That's
have to, we didn't have to come out of pocket with anything. And people are gonna say, well, why? How did you do that? It's because we had a seller who was motivated. All he wanted to do was to get money, buy a Porsche, and drive cross country. He had his brother who he tried to sell the deal to. His brother crapped out. He had to take it back. It was one of those deals where it was a tertiary market. Not a lot of institutions were looking at it at the time, and we were the great buyers. But then, to your point, Axel, you do run out of money. So in 2018, we said, let's start syndicating. Everyone's throwing the syndication word around. So we started syndicating in 2018. We syndicated 3 deals, one in 18, one in 19, and one at the end of 2019. So those 3 syndications were a great way. It's just a tool in the toolbox. It is a
yeah.
great way to raise some capital, let your money work for yourself, and continue to scale the operations while your other assets are starting to matriculate. You're able to either refinance those, sell those out, and those syndications were a great stopgap for us.
Mhm. And just to give us a ballpark through those syndications, roughly, like what was your average raise?
Great. First one was a $5.9 million deal. We needed to raise $2.6 million. And I was a little nervous. I'd never done a syndication before, although we had about 700 units at the time. And I was fortunate that we had already started the Jake and Gino platform. We had written a book. We had a couple of live events. And at $2.6 million, we raised it in 48 hours. It was an easy raise for us because the deal was phenomenal.
Wait, you
The
said you raised it in 48 hours?
Yeah, in 48 hours. Yeah, because a lot of friends, family. I think, Axel, the biggest mistake that we made is we only put $100,000 each of us, me, Jake, and my partner Mike, on the LP side because we wanted to, offer the opportunity to as many friends as possible because the deal was phenomenal. We sold the deal 3 years later at $10 million. So our IRR was well above 20%. And we sold it because we didn't want to stay in that Louisville market. We saw that things were changing in Louisville. And if we refinanced the money out, most of that capital would have gone to the LP partners. We would have put a sizable amount of debt on it. And us as the GP would have gotten a little bit of capital return to us. So we just decided, let's sell the syndication. Let's sell it.
Yeah, makes sense. Makes sense, and it's good because you acted in the best interest of your
Absolutely.
investors, your partners, and that says a lot about the team.
Absolutely. And the second deal, $14.5 million deal. I think that one was a little under $4 million raise. Same thing. We raised it not in 48 hours, but it was another healthy deal. Nice, great market. Back then in 2019, there was still healthy demand for multifamily. And then we closed another deal in Lexington, our third syndication. That was a $9.5 million deal. We raised about $3 million for that. And since then, we've exited all 3 syndications, average IRR of over 20. And syndications are one of those tools that if you're saying to yourself, I need to raise capital, I don't have the money. How do I get into a deal? It's a great way to actually add another stream of revenue onto your multifamily business because all of a sudden you're starting to create fees. you have
Yeah.
acquisition fees, you have asset management fees,
Mhm.
disposition fees, refinance fees. You have an investor database where you can start using those investors to find money for that next deal. So if you're out there and you're struggling and not understanding how to, how to get into this next multifamily, look up syndication. It's a great tool.
Yeah, no, that's a very you brought up a lot of good points, and it's far underestimated how the effort you put in your first, let's say, 2, 3 syndications helps you further down the
Yes.
line, even years later, because you can always go back and have those conversations with people who were interested in coming in the deal but didn't. Those who did come into the deal,
Yeah.
as you said, then you build an investor database, and then from then on, it opens a lot of doors. So you're also known with Jake to have developed the your 3-step framework, and I'd
Mhm.
love to hear a little bit about that because I know a lot of people listening will get value out of it. So can you kind of let us know what's that all about?
Well, one day Jake was sitting in his garage. Guy's always got a chainsaw or he's got a rake in his hand on the weekends. And he looks at this wheelbarrow and he's like, okay, the two back legs. Okay. Those are the buy right and the finance right. And the wheel of the wheelbarrow is the manage right.
Mhm.
It's interesting because if you're buying an asset, whether you're buying a business, whether you're buying a single family, or more specifically for us, a multifamily, those two back legs, once you do the buy right and once you actually, act on the finance right, they're fixed, they're done. It's the third wheel, the manage right wheel, which most people get tripped up on. And if one of those three is off in alignment, guess what happens? The wheelbarrow tends to tip over. And it's interesting because if you're looking at, the operators over the last 3 years, where have they gotten into trouble? A lot of this short-term bridge financing. Now, there's nothing wrong with bridge financing if you're experienced and if you can move quickly and if you have a proven model and
Yeah.
your assumptions are somewhat conservative. But what's happened over the last 3 or 4 years is that operators don't really have great operations. They're trying to rehab a 200 unit property. It's going to take them 4 years. Well, your bridge debt is only good for 2, possibly 3. They're doing extending and praying. So that leg, well, guess what happened? The wheelbarrow
Yeah.
tipped over. And oh, by the way, you're not able to manage it because you don't have processes, you don't have systems, you don't understand how to manage the asset. So I think even if you're looking to buy a business, you need to buy the business based on actuals, right? It's interesting. You're buying on a pro forma. Well, you're borrowing, let me put it this way. You're buying an asset really based on, you're looking at this pro forma, right? You have to understand what you're buying. And we can get into the buy right criteria because that's really important. But
Sure. What
you're
does that
all,
mean for you? Because
well, from,
we have very different markets in Canada and in Florida or in the East US. So I'd love to hear, what does it mean for you to buy right? Is it just
that's a
to buy at a
yeah.
discount?
No, that's a great question. For us, even in the United States, your buy right criteria in California is a lot different than, let's say, in Cleveland. In
Yeah.
California, your buy right criteria is appreciation. You're really not going to make cash flow there. So don't go out and try to find cash flow. And you're going to go into a tertiary market or a really small market, but that in and of itself is something different. When I think of buy right criteria, I'm thinking of criteria that I need to look at a specific asset. What are the fundamentals? First thing we look at is median income. What's the area that you're buying this asset in? Well, we know in our market of Knoxville, anything north of $50,000 median income is okay. Because if you're going to rent out a unit, you can only get 3 times, whatever renters are making. So if they're
Yeah.
making $5,000 a month, your top rent is going to be $1,500 a month. So you have to understand that. So median income is important. The next component I would say is if you're going to be really high level, flood zones. Understand if your property is in a flood zone. If it is, do you say no to the property? For us, you may say no because the insurance may be extremely high. But if you can build that into your model and you can absorb those insurance costs, then go for it. But for us, we try to stay away from flood zones. The next component in this part of the market cycle, we're looking for age of the asset. When Jake and I started, we were buying old assets because the pricing was a lot cheaper for the old assets. But now, as we've gotten longer into the market cycle, the deal we're just closing in 3 weeks, it's a 2019 build. We're looking for newer assets. So
Yeah.
the next component on our buy right criteria, unit mix. We love 2 beds, 1.5 bath townhomes. We love garages.
Mhm.
We love the apartment home, right? That's
Yeah.
what we're looking for. And now if a property comes all studios, are we going to say no? Probably, but it depends. It depends upon the price
Yeah.
point, depends on the median income. So these are only certain criteria where you look at them and in its totality. We
Mhm.
love washer dryer hookups, those kinds of amenities. We
Yeah.
like brick. We like pitch roofs. So when you're looking at a market, start filling out what your criteria is. And why is that important, Axel? Because when you have conversations with a potential broker that you're speaking to, I can say, hey, Axel, I'm looking for deals, 50,000 median income, 2-bed townhomes. We love washer dryer hookups. Hey, anything 10 units up to 300 would be phenomenal for us. And hey, by the way, if there's garages, we love that as well. Now, when the broker hears that and they come across a deal like that, like they did 3 weeks ago with us, they're going to pick up the phone and go, Gino, I've got this deal for you. Guess what? And it takes a lot of the guesswork out
Yeah.
of it. But the important thing is that criteria, the buy right, continues to change as the
Mhm.
market starts to change. So now, as you get longer into this, I guess, cycle, the buyer's market, you may go back and start looking at some assets that are older just because prices are starting
Yeah.
to reset.
And I like the way you describe the framework with the buy right, the finance right, and the operate right.
Hmm.
Now, over the last 2 3 years, I mean, been a lot of changes on the financing side. I know it's
Yes.
been drastic in Canada. In the US, you've had your fair share also of fluctuations. How has that impacted the market since the end of 2021, beginning of 2022?
Well, I think people have real short-term memories. The reason why this all came about was there's been low interest rates in the United States of America for the last 7 or 8 years.
Abnormally low.
Abnormally low. Cost of
Yeah.
capital has been abnormally cheap. So all
Yeah.
these family offices, all of this private equity has capital to place. So what did they do? They went into multifamily as an alternative asset. I was reading a stat that they had maybe 6 or 8% on their balance sheets. Now it's up to 15 and maybe 20% on a lot of
Mm.
these family offices. And private equity was jumping in because they saw the scalability of multifamily. They just didn't understand that, hey, you have to operate the business. You just
Yeah.
can't buy and do a value add. So as you see people getting into the market, what was happening was prices were getting so elevated that these stabilized deals, they weren't able to be purchased at a traditional cap rate. We're buying stabilized assets on bridge debt. That should have been the first red flag. And it was for anybody in the industry going, what is going on? But there was so much capital and so many newer investors jumping in, and all these LPs or passive investors saying, I've got an extra 100 grand from the bank. I got this PPP money. I got all this much free money. I'm just going to put it with these guys. I made money for the last 4 years. It's going to continue. And the way they funded these deals was with this short-term bridge debt, bridge financing, because it was unstabilized. These assets were not stable. Their debt coverage ratio was below 1. So they
Mhm.
thought, hey, I'm going to push it off. Rates are going to stay low forever. And then what did the Fed do? The Fed decided to raise rates 11 times in the shortest span in history. That shocked the market. So when your cost of capital is 3.5%, and within 2 years, it goes to 8 or 9, it tends to blow up a lot of deals. And that's where we are. We're in that period right now where in the next year, there's going to be some motivated sellers. That's why
Yeah.
everyone's like, it's too risky. Now is the time. If you're thinking about getting into investing, multifamily, single family, self-storage, now is the time to build relationships, to talk to brokers, to talk to property management companies, to start talking to investors, because there will be I think, to me, an influx of deals over the next 12 to 24 months. No doubt about it. Go back
Mhm.
to 2011 and 2012, do your history. Cap rates were compressing until '08. They started to decompress after '08 to like around 2011 or 12. It's happening right now. Cap rates hit a high around maybe end of 2022. They're starting to decompress right now.
Yeah.
Prices are starting to readjust. We're just waiting a little bit more for sellers to, I guess when you're a seller and you were told by a broker, hey, you could sell your property for $3 million, and that was a year and a half ago, you still got that $3 million number in your head.
Locked in.
No, it locked in. And buyers,
Yeah.
buyers are not overpaying right now. Buyers understand that there will be opportunity. So why am I going to pay $3 million to Axel when I know his property really is worth 2.2? I'll
Yeah.
just sit out and wait.
Oh,
That's what's
wait.
going on right now.
Yeah. It's interesting that you described this, y the status in the US, because a week or 2 ago, Canada announced the first lowering 25 beeps, from the Bank
Ah,
of Canada, and so for now, people were like, "Oh, finally, after a year and a half of tightening,
yeah.
now we're starting to unsqueeze a little bit." And at the same time, there hasn't been as many bankruptcies as there is now, because we're getting towards the peak and the end of the cycle, and people are like, "Oh, Bank of Canada is starting to lower the rates. It's going to get better." It's like, yeah, but there's huge time lag.
Yes.
Yes, there's going to be probably another like 25 beeps before the end of the year, but for this to trickle through the system, there's still a lot of time. And
Yep.
so I think as buyers right now, it's still raining gold. There's still plenty of opportunities. There's still plenty of distressed sellers, and there's going to be for another year, year and a half, because the ones that are feeling the squeeze are the ones who bought in 2020 and who just they're at the end. They just can't do it anymore. So it's maybe a couple of months, and then they're going to have to come out of the market, and that's good for people who are there to catch it.
Hmm. Axel, it's interesting because everyone talks about a market cycle, and I think it's more in alignment with an interest rate cycle because
Yeah,
the Fed understands and Jerome Powell
well said.
understands that we have inflation, and I don't care what you say, because when you go to a restaurant and you see 3% for credit card charge and 3% for kitchen appreciation, that's inflation, everybody. That's 6% right there that wasn't there 2 years ago. And if they lower rates and everyone starts jumping back into the market, inflation's only going to get even worse.
Oh yeah.
And then there's much flurry. So here, they're sort of like hedging. They thought it was transitory 2 years ago, and they knew it wasn't. So they should have raised rates sooner, slower. They made that mistake. So now I don't think Jerome Powell is going to make the same mistake by lowering rates here and spurring some kind of economic recovery quicker than what he wants. So for us right now, I think there's a whole pattern right now, and I think they're smart to do that, to be honest.
So they're holding off. And what's the mood like in the US? The belief is still that maybe in the fall it'll come.
It's interesting. I read a lot of articles. There's a lot of these big hedge funds, a lot of these big groups are starting to default on their debt. Because they're like pray and extend. They've been buying these short-term instruments, and I think they were all praying over the last 6 months that we were going to have some kind of relief with these interest rates, and they haven't come. And I don't think they're going to come. Not to get political, but the reason why in 2022 they did not raise rates soon enough was because one party in power wanted to win the midterm elections. That's my conspiracy. And after that election occurred, all of a sudden you're going to shock the system that quick. They played the short game because now we've got another election coming on. And
Yeah.
if it was true to what they used to do, rates would have been dropped. But they can't do that now, because if they do that, it will be they will not be able to rein in the inflation if they end up doing that. So they're sort of caught right now. And I don't see rates dropping. I thought they would drop, but I don't see rates dropping right now. But that's okay for a real estate investor, because it costs me 6.5. It's going to cost Axel 6.5. We're at a level playing field. And I don't think
It's even for everyone.
exactly. And I think if a deal works at 6.5 right now, can you imagine when rates do drop? Party's on, my friend.
Yeah. So it's funny you say that, because that's exactly what I tell some of the other buyers as well. Is like, figure it out a way to make it work. And when
Yes.
interest rates drop, imagine how laughing you're going to be. Like, it's
Yes.
just because there's still the deals to be done right now. Yes. And you marry the property, you only date the interest rate.
You marry the price, right? I like that.
Mhm. So you also have the value-based decision making. Was that developed by Jake? Like, what is it all about?
I wish it was. I had a mentor, Rick Sapio. We joined forces a couple of years ago, and family-based guy, really a person with great integrity, great character. And I like how he described it to me. Every decision that he made was based upon his values. He had something he calls cathedral thinking. Now think about the Middle Ages when they built cathedrals. Gino and Axel are sitting there laying bricks. Well, Gino and Axel ain't going to see that cathedral built. It's going to take 100, 150 years. So that long-term vision, that long-term mindset. And when you think about values-based decision-making, I think one of the best decisions I made was partnering with Jake. And I didn't know this subconsciously, but when I partnered up with him in 2009, our values really aligned. We were both long-term thinkers. We were both family guys. We both worked really hard. We were both committed to each other. We were both committed to the vehicle of multifamily. So that decision to partner with him was based really upon our values. And I think if you're listening to this right now, do you know your values? I mean, if you do, are you living by those values? And more importantly, are you making decisions and goals based upon your values? We didn't go into RV parks and to mobile home parks a couple of years ago when there were no multifamily deals. That wasn't based on our values. We want to become what we say the Chick-fil-A of the apartment industry by delivering superior customer service. So if we start buying other assets that have nothing to do with multifamily, it's going to take away from our objective. So it's real easy, you think about it for 5 minutes and go, no, we didn't start a fund to sell and buy crypto, because that's not who we are. We're in multifamily. So you see how, it's very easy.
Yeah.
I mean,
No.
and I'm not going to buy a 1950s asset that's going to take a lot of work and I'm going to overpay on it. That's not based on our values. So if you can really sit down, flush out what your values are. Think of 3 words that really define who you are. I did this exercise. I'm dedicated. I'm hardworking, and I'm committed. Those three values I try to bring to the table every day in whatever I do. And everything and every decision I make is based upon my values. And listen, we all make mistakes. Back in 2017, I partnered up with a couple of guys here in Florida. I look back at the decision as being really bad because I partnered up with them, not based on my values, but based on what they were trying to accomplish. And it was getting that shiny object. And I can blame them. But at the end of the day, my values are based on 100% responsibility. I need to be responsible for my actions. I made a mistake. I'm partnering with them. So anybody, when you're out there, you're making decisions, make them decisions based on your values because everyone's values are different. And I think at the end of the day, when you do something that's great and you feel in alignment with yourself, I think happiness ultimately comes from those decisions based upon your values.
I love the way you reframed it. And to summarize, like to really be aligned with your values, because maybe that partner is going to come and go, but your values you have to live with. So you better
Yes.
be aligned.
Yes, I agree.
No, no, I completely thank you for sharing that, Gino. That's really important. And for all those who are listening, it's sometimes tempting to get the shiny object syndrome and change asset class like you described earlier and so on, but you gotta stick to what you chose.
I agree.
Gino, if anyone would like to get in touch with you and learn more about you and your business, what's the best way to do so?
Just go to jakeandgino.com. I mean, Axel, if your listeners want to listen, want a copy of our book or PDF copy, just email me, Gino at jakeandgino.com, and I'll send you a PDF copy of Wheelbarrow Profits.
That sounds like a plan. All right. And then anyone in Florida, just go hit up Gino. Always open for a conversation.
Always. I'm always open. I mean, come on, really. At the end of the day, when you can
It's
sit down and
fun.
talk real estate and finance and
Yeah.
impacting people's lives, and you can do that, I mean, life is good, my friend.
Yeah. Well said. On this wonderful note, as usual, please share this episode with a friend who could benefit from this conversation. Leave us a review, send us some comments. I'm in the process of booking my guests for throughout the summer. If there's anyone or any topic you'd like to hear about, please let me know. There we go. On this note, as usual, keep researching your market, keep making offers. I'll talk to you next week. Thank you.